Okay, welcome to another run through of the top 5 charts of the week. This is the free weekly email that goes out to subscribers of the website. Chart number 1 here, global leading indicator breadth. So the red line here is a little bit of an unusual indicator. What it is here is the proportion of OECD composite leading indicators that are above 100. Now, rather than get into the specifics of that, all you need to know about this indicator is the higher it is, the more widespread growth is, and the more widespread the acceleration of growth is, and vice versa. I mean, it lines up pretty clearly with global equities. You can see there the MSCI All Countries World Index in the black in local currency terms. And the reason why this one's an interesting one is that when it rolls over from a high point, typically what you see after that is some sort of bear market or financial crisis, or just a garden variety correction. And we've seen that not so much in the MSCI ACWI, which is, to be fair, is pretty dominated by the US, which has just kept on going up, as most people are aware. But the MSCI ACWI ex-US has definitely rolled over, and that divergence there maps to the economic divergence that we've seen, and that's one of the most important themes out there at the moment. I'll go into that later, but on to the next one. China versus copper. This one's also pretty interesting, and it's kind of echoing some of what we saw in the first chart there. I was pretty bearish on copper around the turn of the year, late last year, and that was largely down to the China factor. And so you might say, well, is it the spurious correlation? Why are you looking at copper in China? China is responsible for about half of the world's consumption of copper, and particularly if you think about the Chinese economy, what drives it, property is a major factor, and property is a major source of copper demand. So it makes sense that you would see these cycles sort of somewhat aligned, and we're getting to the point where China growth slowdown that we've seen here is going from a situation of being just plain bad to so bad that it's good. Now, what do I mean by that? Well, from an investing standpoint, a little bit of a slowdown in China is a bad thing, but too much slowing can actually be a good thing, because it can prompt the policymakers to take a more proactive stance, implement more stimulus, and that not only has very, very real implications for commodities, emerging markets, Chinese assets, but very much a sentiment aspect as well, helps boost risk appetites. So where we're at now compared to where we were at, I think the risks are a bit more balanced, or certainly less one-sided at this point. Number 3, Treasuries. Now this one's quite interesting. It shows speculative futures positioning in US Treasuries, and basically traders are very bearish Treasuries. They're expecting bond yields to rise. And that's quite interesting in the context of the previous two charts, because if you think about what drives bond yields higher, well, for the most part, when you're talking about if you want to leave sovereign credit risk out of it for now, because it's not really relevant for America. Some people might muse that it could be at some point, but really it's off the table, that kind of thing. So it's really down to growth and inflation. And so to be bearish on bonds, to expect higher bond yields, I mean, obviously central bank policy plays a really important role, but really it's growth and inflation outlook that drives the bulk of the movement there. So while you do have a sort of a bearish overtone to these first two charts, this one is implying kind of the opposite. But it goes back to that thing that I mentioned before about that divergence there, that the outlook for America is pretty solid. And so I said back here, my base case is actually that global growth picks back up. I think it's fair to describe this as sort of a growth wobble, and there's certainly potential factors that could kick off a self-reinforcing cycle to the downside, or a bit of a negative feedback loop. We're not seeing that yet. I'm very wary of that, but I'm not seeing that yet. But anyway, on to number 4. Very similar to the previous chart, we've got futures positioning once again, but we've also got equities, which is stocks. So this is aggregated across the major US benchmark futures, and basically got pretty heavy net longs by traders and net on inequities and net short in bonds, and you know, that gap there is actually the most extreme on record. And the interesting thing about that is that they're pretty much both the same bet in many respects, because if you expect higher bond yields on the back of better nominal growth outcomes, so higher growth and inflation, then that's the type of thing that's supportive for earnings growth and earnings margins, etc. And that tends to be bullish for equities as well. And of course, there's a few complicating factors there. If bond yields rise too much, and the equity risk premium can be squeezed to negative, and that can cause a few issues in and of itself. But at this point, it's interesting. It's a compound bet basically. So these are two of the same things. So in that respect, they're kind of consistent. But it goes to show that there is that level of optimism, those high expectations, and the risk is when you have these high expectations is that they don't get met, and then we could see a bit of fun and games, to put it euphemistically. Number 5, the Fed versus credit. So this is a pretty interesting chart too. The black line there is US high yield credit spreads. They've actually tightened up to the lowest point since just before the financial crisis. And that's quite interesting, really, because if you think about credit spreads, there's a few things to sort of talk about or note there. First of all, when you're at these kind of levels, you're getting paid very little credit risk premium. Now that's okay at the moment, because when the economy is booming, most businesses don't default. They tend to just keep on going, and even the worst business can make money in an economic boom. When the downturn comes, of course, that kind of credit risk premium is not going to be anywhere near the kind of the kind of thing that will offset that kind of risk. So that's another way to look at credit spreads, is to flip it upside down and say, well, it's the same as a PE ratio. A high PE ratio basically implies future, really positive future growth, and very much similar for credit spreads. So we're left with a situation where spreads are looking basically overvalued, and at the same time it's a bull market. So what do? Well, one of the things that you do is you look at potential leading indicators, or red flags. From my point of view, I've got a bunch of different indicators that I look at for credit, and I'm getting a couple of orange lights or yellow lights, if you think about a traffic light. No red lights as such. The only red light really is just how tight credit spreads are. But one thing that is definitely an orange light is what the Fed's doing here. So if you look back at history, usually when the Fed hikes rates, sooner or later, and sooner or later in terms of the magnitude of the hikes, you get a widening of credit spreads. Basically the Fed blows up the credit market. And the mid-2000s is a good example of how long that can sometimes take. There's been instances in the past where it's only taken really one hike to blow credit spreads out. But I think each incremental hike raises the risks. So just like equities, thinking back to that valuation aspect again, the time to be buying, in anticipation of tightening credit spreads, with the expectation of having enough of the credit risk premiums, is when you get the spikes, not when the troughs. And it very much echoes what we're seeing in volatility markets as well. So look, I will leave it there. If you've got any comments or questions about any of these, just make sure you put them in the comment section of the YouTube video. And if you want to get this weekly email in your inbox, go to topdowncharts.com and subscribe to the mail list there. That's it.